portfolio that I manage, the IDEC strategy, we went a little more bearish right at the end, like the tail end of December. Spiking bond yields in the face of the Fed's desire. September 18th, I think, was the meeting. The Fed cut interest rates, panicked by 50 basis points. Remember? They had to adjust policy because rates were too high. But they don't control long-term interest rates directly. And that's if they're doing some kind of massive QE program, which they're not doing right now. They're doing quantitative tightening. They're actually selling bonds. They control the overnight Fed funds rate, which competes with money markets, competes with T-bills. So they could take that rate down if they want to, and they are, although I think they've stopped now, right? They're kind of like in cement, if you ask me. They can't really cut interest rates much more when inflation has been above their asinine 2% target. I say asinine because it should be zero, right? In my mind, stable prices mean no inflation. And that should be especially true when inflation is up 40, 50% since, COVID, just a few years ago. So it's the level of prices that needs to come down. So 0% would be okay, I guess, better than 3. But any increase in inflation in the first derivative is horrible for the bottom 4 quintiles. So that the rate of change of inflation, the second derivative, is actually accelerating further away from their asinine 2% target, which has been above 2% for 44 months. They say they want 2% inflation. They've missed it to the upside for 44 months, and yet they're still talking about maybe one rate cut in October of 2025. But while they're cutting short-term rates, the long-term rates are spiking, and that's really bad for an economy that is oversaturated in debt. Credit card debt, mortgage debt, state and local debt, national debt. As a matter of fact, if you look at total non-financial debt as a percentage of GDP, it has never been higher. So spiking rates aren't good for a frozen housing market, and they're not good for an economy that is debt disabled. When the Fed cuts interest rates by 100 basis points, it's very unusual for long-term rates to rise. They should go down a little bit, but not as fast as short-term interest rates, which means you have a normally sloped yield curve and everybody's happy because nominal interest rates are falling across the yield curve. It's not happening this time. What's happening is short-term rates are coming down on the Fed funds rate, but yields are rising across the yield curve. It's not good news for a stock market that is the most expensive in history. If you look at earnings yield, if you look at that risk premium, so the earnings yield minus treasuries, it's negative and getting worse because rates are rising. I think at best, he's going to keep the Trump tax cuts in place, which is a rate of change of 0. So if he extends the Trump tax cuts in December, they're supposed to expire, which would be a huge $4 trillion tax hike. I don't think that happened. I think he gets it done where he can extend the tax cuts that were in place. But you're not going to see any tax cuts. Maybe you'll see an increase in the SALT tax deduction. But on the other side of that, you're going to see increase in tariffs, which are taxes. I love the deregulation as a libertarian. I love lower taxes. It's wonderful. On the other side of that, countervailing that is half of GDP growth is the increase in the labor force. And we could see significant deportations, and at the very least, we're going to shut down the border. So half of, I think, GDP growth could be in trouble. And then on the other side of that, too, you have, like I said, the tax cuts get extended, but then countervailing that would be deportations, and you have tariffs, which are tax increases. So, you put it all together, and it comes out to me that says, okay, you should have decent growth, not a collapse yet in the economy, certainly not growth that's booming, certainly not 14% earnings growth that's predicted for the S&P 500 this year, on top of a very, very expensive stock market, on top of rates that are rising in spite of what the Fed is doing. So you put it all together, and I am slightly long the stock market now. I was in 2024, I had about 50%, especially towards the end of the year, after the Trump election, I was 60% net long the stock market. And I took that down to only 15 to 20% long right now, because I just mentioned the unstable and tenuous nature of the Treasury complex. I look at it this way. You have 3 things going against you in the Treasury complex. You have inflation, insolvency, and illiquidity. So the liquidity for the T-bill, all the debt is financed, thank you, Janet Yellen, at the very short end of the yield curve, the T-bill market. Well, that was wonderful because you had $2.3 trillion in the reverse repo facility, which is now $100 billion in the reverse repo facility. This is all the excess money that was created by COVID stimulus. stimulus. It ended up as excess reserves, and then the Fed, sold treasuries and soaked up those reserves. And those reserves now are gone. They went back out of the reverse repo facility and went into the T-bill market. So you had kind of quiescence in the treasury complex. There's a lot of illiquidity there now because that facility is almost done. In fact, for all intents and purposes, it is gone. That's why you're seeing the rates starting to rise. And then you add to that the fact that inflation is still rising. If you look at Michigan consumer confidence, inflation is actually much higher. It jumped from 2.8 to 3.3 inflation expectations. If you look at the ISM services sector, which is the largest part of the economy, prices paid jumped, I think, to 64.3, if I can remember, from where it was the month ago. So inflation expectations are rising. That doesn't sound like an environment where the Fed should be cutting interest rates, does it? Not the way I think of things. So you have inflation, you got illiquidity, and you have insolvency. You look at the nation's assets minus all of their liabilities, insolvent. And that means you have massive issuance of treasuries. This is my prediction. Treasury yields will rise until the economy falters. And I think it will in 2025. So there's a self-governing aspect of these treasury yields. Prices fall, yields rise, it hurts the economy, and then you could get into a problem with the treasury market. You could have a Liz Truss moment like they did in England, rates spike, and then you could end up with a real disaster in the stock market, which would kill the spending in the top two quintiles that have been keeping the economy going. And then it could also hurt the housing market, which is really on tenterhooks right now. When you put it all together right now, as an investor, I'm slightly long. I'm looking very closely at that treasury complex every day. Yields get anywhere near 5% on the benchmark, and I think it could be lights out for the stock market. I have a very small position, about 4%, in an inflation hedge, which does contain gold mining royalty companies. And I was very long gold, 15, 20% at times last year. I rode that up nicely. For now, I am temporarily very unallocated to gold. And the reason is gold does not like rising nominal interest rates and doesn't like rising real interest rates, which is exactly what's happening right now. You also have a very strong dollar. You've got a lot of competition from Bitcoin. You have a president who's just been elected who's the Bitcoin czar. He loves Bitcoin. He doesn't talk much about gold, but he wants the United States to be epicenter of cryptocurrencies. So I prefer he link the dollar to gold and not cryptocurrencies. I am not negative gold, but I am out of it right now. But I think that's going to be short-lived because once the economy starts to falter, it's going to really take off to new highs, in my opinion. So again, getting the timing right on the precious metals is very, very important. I don't bunch commodities in one monolithic group. So there's base metals, energy, and then there's precious metals. And sometimes they go together higher and more often than not. Again, we have a total market cap of GDP. That's 200%. If you look at the total market cap of equities as a percentage of the underlying economy, that is very, very high. And if you look at things like price to sales, CAPE ratio, if you look at equity risk premiums, this is an extremely expensive stock market, at least on the headline indices. So you're very vulnerable here to any kind of interest rate spike. So if you do get a stock market that falls due to spiking interest rates, which would also affect housing and also things like private credit, which is a multi-trillion-dollar new industry that spawned out of nothing. And one thing about private credit is it's private. What are the prices? You don't know. What's the liquidity there? It's very limited. So what's the reaction to the top quintile of investors, which has kept the economy afloat? Because your portfolio of houses and your portfolio of equities has done very well, and your private credit looks pretty good too, at least you can assume on paper. What happens when those things go in reverse? And you can have a sharp drop in GDP, which would just be like a negative feedback loop for the stock market and for the economy. My portfolio right now is highly invested in Treasury T-bills and the shortest end of the yield curve. We do have some exposure to inflation. We do have some exposure to low volatility stocks. We do have some exposure to aerospace and defense. I think Pete Hegseth just said today that it's very dangerous for the United States to have spending on military below 3% of GDP. He didn't say it was a good thing to cut defense spending. He's going to be very careful. I think he should be about what he spends and make sure we spend appropriately and not be wasteful. But he does want to spend a lot more money on defense. I think this world is getting more dangerous as well. So I have an investment in aerospace and defense too. So net long, about 15%. Comfortable with that for now. Not predicting a big increase in stock prices, not predicting an imminent crash. But the odds are, as we go through the year and the liquidity becomes less and less, that we could enter a problem. And I'll reverse what you said. I think we can get a problem in bond market. So bond prices fall and stock prices fall as yields go higher. That's what I think is a very, very likely possibility in Q2, Q3 timeframe. And you know what? For those holding the 60-40 portfolio, 60 stocks, 40% bonds, your 40% sleeve is down about 50% since COVID. If you go out long duration, that's hurt a lot of people. In 2022, it wiped out, the stock market was down 22%, the S&P, but if you add bonds to it, it was a real disaster. That's what I'm most concerned about, because bonds aren't really cheap right now. You can't make an argument. So if you have 2% growth and 2% inflation, that's trend growth plus 2% inflation. And we're not at 2, but let's just say you get there. You get 4% and you get like a few 50 basis points in earnings above that inflation and nominal growth above inflation and real growth. You get 4.5. I mean, that would be a good, I guess that's the bottom. But what happens if inflation is higher like it is now? So what I'm trying to say is, and this is the most important point, the only thing that in my mind can really bring quiescence to the bond market is faltering GDP growth, which would kind of bring people into the long end of the bond market curve. But it would be disastrous for those that expect 14% earnings growth, which is needed to support what the equity prices are. The risk-reward ratio for being in a buy and hold 60-40 portfolio is extremely dangerous right now. You can actually invest in the inflation, deflation, and economic cycle portfolio that looks at the most important thing, which is the second derivative, the rate of change of inflation in the context of economic growth. And I apply that output to a spectrum, 5-sector spectrum that ranges between deflation, where everything goes to a correlation of 1 and everything goes down except cash and bonds and the dollar and shorts. Shorts tend to go up when the market goes down. And stagflation or intractable inflation, where you cannot short the market. It's very difficult to make money in intractable stagflation. You can in the right areas, but shorting indices is very difficult. But you have to be long base metals and energy and precious metals so you can get a real return on your investment. So knowing where you are in that spectrum is crucial. Is it, 100% flawless? No, but it gives you an intelligent way to profit from bull markets and to protect and maybe profit from bear markets. And the downside here is significant.